Welcome back to TalkTickers. Today, we're going to try to dissect American Tower's Q3 2024 earnings call, which just wrapped up this morning.
Yeah, you're right. A lot to unpack here. American Tower, ticker symbol AMT for those following along at home, really had a quarter that I think reflects the shifting landscape of the industry.
Okay, so for our listeners who might not live and breathe cell tower REITs every day, what's the headline? What jumped out at you?
Well, what I think is so fascinating is the contrast. You have strong global demand, which is always a good sign, but the company's also making some pretty strategic adjustments. It's like they're trying to find the sweet spot in a market that's evolving so rapidly.
So kind of like they're trying to future-proof themselves for whatever comes next in the 5G rollout.
Precisely. But before we get ahead of ourselves, let's start with the fundamentals. American Tower reported solid Q3 results, and they emphasize that demand is strong globally. I think that's a key takeaway right off the bat.
But didn't they recently sell off their India business?
Yeah.
How does that impact the overall picture?
That's an excellent point. The sale to Brookfield definitely adds a layer of complexity. Those results are now reported separately as discontinued operations. So it's essential to look at the new metrics that they've introduced. So attributable AFFO and attributable AFO per share, think of it as focusing on the core business and filtering out the noise from the India sale. This gives us a much clearer view of how the core American Tower is performing.
Okay, so we're essentially looking at a slimmed down American Tower, but they're still seeing strong demand. That's got to be reassuring for investors, right?
It is. And what's even more interesting is that within this core business, their U.S. data center segment, Corsite, is firing on all cylinders. They reported exceptionally strong demand exceeding their initial projections, and they're on track for a third consecutive year of record new leasing.
3 years in a row. That's not just luck, right? What's driving that kind of performance?
Yeah. Well, it's a combination of factors. First, they're capitalizing on major industry trends like hybrid and multicloud IT architecture. Businesses are increasingly relying on a mix of cloud and on-premise solutions, and Corsite is providing the infrastructure to support that.
So they're positioned right in the sweet spot of this shift in how companies manage their data.
Exactly.
Okay.
And second, they're executing well on cost management initiatives. They've been very focused on streamlining operations and improving efficiency, and that's translating into an expansion of their cash-adjusted EBITDA margin. Essentially, they're doing more with less.
And investors always love to hear that. Efficiency leads to profitability.
Absolutely. So you have this interesting dynamic of a company adapting to change while also delivering strong financial performance. Now, let's delve deeper into some of the specific areas that caught my attention during the call. Let's start with Europe. It's been a hot topic in the tower industry, and for good reason.
Yeah, everyone's watching what's happening over there. Yeah. What's the story with American Tower's European operations?
What I find remarkable is their disciplined approach. They've been very strategic about entering European markets, particularly in Germany, France, and Spain. Instead of rushing in, they've taken their time, negotiated favorable terms, and really ensured that every investment aligns with their long-term goals.
So being selective rather than trying to conquer the entire continent.
Precisely. And this strategy is paying off. They're seeing really impressive organic growth in Europe, averaging over 7% over the past 3 years. That's a testament to their careful planning and execution.
Okay, so they're not just growing, they're growing profitably. But what's fueling this growth? Is it just the overall demand for mobile data, or are there other factors at play?
Well, there are a couple of key drivers here. First, you have healthy carrier demand. Mobile data usage continues to rise in Europe, and carriers are investing in their networks to keep pace. This translates into more business for American Tower as carriers need those towers to support their expanding coverage.
So they're riding the wave of mobile data growth, but what's the second driver?
This one's particularly clever: CPI-linked escalators. Basically, their contracts have built-in price increases tied to inflation. This means that as the cost of goods and services rises, so does their revenue. It's a brilliant way to hedge against inflation and protect their profitability.
Smart move, especially in the current economic climate.
Exactly. Now, one thing that came up during the call was the issue of ramp sharing. This is where multiple carriers share space on a tower, potentially impacting revenue for companies like American Tower. It's been a concern for investors, but the company addressed it head on.
So what's the strategy for dealing with ramp sharing? Are they just accepting it as a fact of life, or are they fighting back?
They're definitely not just sitting back. They've been very proactive about structuring their agreements to mitigate the impact of ramp sharing. In some cases, they've negotiated terms that allow them to monetize the sharing, essentially turning it into a revenue opportunity. In other cases, they've secured protections in place to ensure that their growth targets are met, regardless of how many carriers are sharing space on a tower.
So they're using a combination of strategies to make sure ramp sharing doesn't derail their growth.
Exactly. And they seem confident that they can continue to deliver strong organic growth in Europe even as ramp sharing becomes more prevalent. They also have the option to invest in new site builds if needed, giving them even more flexibility.
Okay, so Europe is shaping up to be a key growth driver for American Tower. Now, let's shift gears and talk about their U.S. data center business, Corsite. We touched on their record-breaking leasing earlier, but I'm curious to understand what's making them so successful. What's their secret sauce?
Well, I think their success boils down to a few key factors. First, they're riding that wave of hybrid and multi-cloud IT architectures, as we discussed earlier. This trend is creating massive demand for data center space, and CoreSite is well-positioned to capitalize on it.
So they're in the right place at the right time, but that's not all, is it?
No, it's not just about being in the right market, it's about having the right strategy. And that's where CoreSite's interconnection campus model comes into play.
Interconnection campus. That sounds intriguing. Break it down for us.
Think of it like this. Imagine a bustling city center where businesses, organizations, and networks can easily connect and interact. That's essentially what CoreSite is creating with their interconnection campuses. They're bringing together a diverse ecosystem of players under one roof, facilitating seamless data exchange and collaboration.
So it's not just about providing space for servers. It's about fostering a vibrant community of interconnected businesses.
Exactly. And this model is proving to be very attractive to customers who are looking for speed, efficiency, and flexibility. It's also potentially very synergistic with their tower assets at the edge as edge computing develops. Imagine the possibilities as these two worlds converge.
Okay, so they're building these interconnected hubs. But how does this all tie into the rise of artificial intelligence? Everyone's talking about AI, and it seems like it's going to have a huge impact on the data center industry.
You're right. AI is kind of the elephant in the room, and CoreSite is already seeing the impact. They're seeing a growing number of leases that are tied to AI workloads, and their facilities are designed to handle the unique demands of AI, particularly the high power requirements of those GPU-based architectures that AI relies on.
So they're ready for the AI boom, but are they also considering those massive hyperscale data centers that companies like Google and Amazon are building? Is that part of their strategy?
Interestingly, they're not chasing the hyperscale trend, at least not in the same way that some other data center providers are. They're sticking to their multi-tenant colocation model, focusing on building a robust interconnection ecosystem that serves a diverse range of customers. It's a different approach, one that emphasizes flexibility and specialization rather than sheer scale.
So it's like they're choosing to be the Swiss Army knife of data centers rather than the sledgehammer.
That's a great analogy. They're catering to a broader range of needs, and they're doing it exceptionally well. Now, before we wrap up our discussion of CoreSite, I want to highlight one more point that I found particularly interesting. During the call, they were asked about their willingness to pursue hyperscale development, and they didn't rule it out entirely. They said they'd consider under certain circumstances, specifically if it would help them seed a new campus or if there were compelling joint venture opportunities.
So they're open to it, but only if it fits their strategic goals and doesn't distract from their core business.
Precisely. It's about being disciplined and focusing on what they do best. So far, that approach seems to be working wonders for them.
Okay, so we've covered their overall performance, their European operations, and their data center business. Now let's talk about the numbers. What did they have to say about their financials and guidance for the rest of the year?
Well, as you might expect, their full-year outlook has been adjusted to reflect the India sale. Everything is now based on continuing operations, so we're getting a clear picture of the core business moving forward.
Makes sense. But besides that big change, were there any other notable updates to their financial outlook?
There were a few things that caught my attention. First, they had to take some provisions related to WUM Colombia, a customer that filed for bankruptcy earlier this year. It's definitely a setback, but importantly, WUM Colombia represents a relatively small portion of their overall revenue. They've reserved a portion of outstanding revenue and are recognizing revenue on a cash basis going forward, essentially taking a cautious approach until this situation with WUM Colombia is resolved.
So not a major blow, but still something to keep an eye on.
Agreed. Now, for some positive news, they've actually increased their property revenue expectations for the year. This is being driven by the strong performance of their data center segment, that Corsite success we talked about, and also a customer settlement in Brazil. So they're effectively offsetting the Columbia hit with other wins, which is reassuring.
Okay, so they're taking some hits but also racking up wins. What about their expectations for organic tenant billings growth? Did that change at all?
No, their expectations for organic tenant billings growth remain unchanged, which is a good sign. It shows that they're confident in their core business and their ability to continue generating revenue from existing tenants.
That's always encouraging to hear. And what about their overall profitability? Did they update their adjusted EBITDA outlook?
They did, and it's actually an upward revision. They've increased their adjusted EBITDA outlook for the year, driven by revenue growth and those cost management efforts we discussed earlier. So they're expecting to be even more profitable than they initially projected, which is a testament to their operational efficiency.
So overall, the financial picture seems pretty healthy. Now let's talk about one of the most important things for investors, their dividend. Did they provide any updates on their dividend policy or their plans for future payouts?
They did, and I think income-oriented investors will be pleased with what they heard. American Tower reaffirmed their commitment to their dividend, and they even signaled that they plan to resume dividend growth in 2025. This follows a period of holding the dividend steady, so it's a positive development for those who rely on those payouts.
So they're essentially saying they're confident enough in their future earnings to start increasing those dividends again.
Exactly. They also provided some context around their dividend policy, emphasizing that they take a long-term view and aim to align dividend growth with their average AFFO per share growth rate. This means they're not going to chase unsustainable dividend increases. They're going to focus on steady, sustainable growth that's supported by their underlying earnings.
That's a responsible approach, and it should give investors confidence in the long-term sustainability of those payouts. Now, besides dividends, what else are they planning to do with all that excess capital they have on hand?
Well, they've got a few options. They can invest it in their CapEx programs globally, which would fuel further growth. They can buy back shares, which would return value to shareholders and potentially boost their stock price. Or they can reduce their debt, which would strengthen their balance sheet and give them even more financial flexibility.
So it's a balancing act, weighing those different options and deciding how to allocate those funds to maximize value for shareholders.
Precisely. And they're going to make those decisions based on market conditions, their strategic priorities, and their overall assessment of where they can get the best returns. But one thing's for sure, they're not sitting on their hands. They're actively looking for ways to deploy that capital and create value.
All right, so they're generating cash, paying dividends, and looking for opportunities to invest and grow. That sounds like a pretty good position to be in.
It is. Now, with all that said, there are still some key questions that I think investors will want to consider. One of the big ones is how the mix of colocations versus amendments will evolve as carriers move into the densification phase of 5G. This will have a big impact on their revenue streams, particularly as their existing master lease agreements mature.
Okay, so explain that to me like I'm a 5-year-old. What's the difference between colocations and amendments, and why does it matter so much?
Imagine you have a big house with several rooms. You can rent out those rooms individually, or you can rent out the whole house to one tenant. In this analogy, the house is a cell tower, the rooms are spaces for carriers' equipment, and the tenants are the carriers themselves.
Okay, I'm following so far.
A colocation is like renting out a single room to a carrier. It's a direct agreement between American Tower and that carrier, and it's typically priced based on the specific space and services being provided. An amendment, on the other hand, is like adjusting the terms of an existing lease agreement for the whole house. It might involve adding more space, upgrading equipment, or extending the lease term.
So colocations are new deals, and amendments are changes to existing deals.
Got it.
Exactly. Yeah. Now, American Tower has these master lease agreements, or MLAs, with major carriers. These agreements cover a lot of their tower space and have pre-negotiated terms. As carriers move into the densification phase of 5G, they'll need to add more equipment to their towers to support the increased capacity and coverage demands.
So more equipment means more potential revenue for American Tower.
Right. But the question is, will this new revenue come from colocations, which are typically priced higher and give American Tower more flexibility, or will it come from amendments to those existing MLAs, which might have lower pricing and less flexibility?
Ah, I see. So the mix of colocations versus amendments will determine how much they can benefit from this densification wave.
Precisely. And that's something investors will be watching very closely. They'll want to see if American Tower can strike the right balance between leveraging those existing MLAs and securing new colocation deals that maximize their revenue potential. Okay, that makes sense. Now, another big question is about their strategy in emerging markets. Given their focus on developed markets and the tightening of capital expenditures in emerging regions, are they going to continue investing in those markets, or are they going to pull back?
That's the million-dollar question, isn't it? And to be honest, there's no easy answer. American Tower has been very successful in emerging markets, but those markets are also more volatile and unpredictable. They're facing currency fluctuations, regulatory challenges, and economic uncertainty. So it's understandable why they might be hesitant to pour more money into those regions.
But they've also built a significant presence in those markets, and they have long-standing relationships with carriers there. It wouldn't be easy to just walk away, would it?
No, it wouldn't. And they've repeatedly said that they're not abandoning emerging markets altogether. They're simply being more selective about where they deploy capital. They're prioritizing investments that have a clear path to profitability and that align with their long-term strategic goals.
So the balancing act again, weighing the risks and rewards and making tough choices.
Exactly. And investors will want to see how this strategy plays out. Will they be able to maintain their growth trajectory in emerging markets while also mitigating those risks? Or will they eventually decide to focus primarily on developed markets, where the growth might be slower, but the risks are lower?
Okay, so lots of uncertainty there, but that's the nature of emerging markets, right? High risk, high reward. Now, zooming out to the big picture, I'm curious to hear your take on American Tower's overall strategic direction. What's the main takeaway here? What should investors be thinking about?
If I had to sum it up in one sentence, I'd say that American Tower is in a transition phase. They're adapting to a rapidly changing landscape, and they're doing so by focusing on their strengths, managing their risks, and making strategic choices that prioritize long-term value creation.
Okay, so they're not standing still. They're evolving, but they're doing so in a thoughtful and deliberate way.
Exactly. And that's what makes them so interesting to watch. They're not just riding the wave of industry trends. They're actively shaping their own destiny. They're making bold moves like the India sale, but they're also being cautious and disciplined in their approach. It's a fascinating mix of pragmatism and ambition.
And that makes for a compelling investment story.
It really does. And, there's so much more to discuss.
Absolutely. There's always more to unpack with American Tower.
Right. And we'll be back in the next segment to delve deeper into some of the specific questions that analysts ask during the call and what those questions reveal about the company's future prospects. I think there's a lot of good stuff there.
Yeah, those Q&A sessions can be gold mines for investors who really want to understand the nuances.
They really can.
Stay tuned, folks. We'll be right back after a short break.
Welcome back to TalkTickers. Before the break, we were talking about American Tower's strategic shift and how they're balancing their growth ambitions with a disciplined approach to capital allocation.
Right. And one of the areas where that balance is most evident is in their approach to cost management. Investors always want to know that a company is being smart with their money, especially in a volatile economic environment like we're seeing now.
Absolutely. And American Tower seems to be taking that responsibility very seriously. During the Q&A portion of the call, analysts were particularly interested in the progress they've made on those cost reduction initiatives. Remember, they had highlighted this as a key priority earlier this year.
Right, so it wasn't just lip service. They've actually been putting those plans into action.
Exactly, and it seems to be paying off. They provided a very detailed update focusing on SG&A, that's selling, general, and administrative expenses for those who aren't familiar with the acronym.
Okay, so the stuff that keeps the lights on, but isn't directly tied to revenue generation.
Precisely. And they've been targeting SG&A as a source of quick wins, looking for ways to streamline operations and reduce those expenses. And the results are encouraging. They said their cash SG&A, excluding bad debt, is down about 3% year to date compared to the same period last year.
So they're already seeing some tangible savings. That's great.
It is. But they're not stopping there. They're looking at broader cost management strategies that go beyond just SG&A. One area they highlighted is the potential for globalizing certain functions, like finance and operations.
So instead of having separate teams doing the same thing in different regions, they're looking to centralize those functions and create more efficiency.
Exactly. It's about finding ways to leverage their global scale and avoid duplicating efforts. They believe this will lead to significant savings over time, although it's a longer-term play.
Okay, so they're thinking both short-term and long-term. They're finding those quick wins in SG&A, but they're also laying the groundwork for more substantial cost reductions down the road.
Precisely. It's a very balanced approach, and it shows that they're committed to continuous improvement. Now, it's important to note that while they're focused on reducing costs, they're not cutting corners when it comes to investing for future growth. They made that very clear during the call, especially when analysts asked about their willingness to commit to those larger CapEx projects.
Because some investors might be worried that their focus on cost management means they're pulling back on growth investments.
Right, and that's not the case at all. They emphasize that they're still open to those large-scale projects, but they're being more selective. They want to make sure that every dollar they spend generates strong returns. It's about quality over quantity.
So being more strategic with those investments makes sense, especially in today's volatile economic climate.
Absolutely. They need to balance those debt levels with their growth ambitions, and that means being more discerning about where they deploy capital. Now, speaking of strategic investments, there was a lot of interest in their acquisition strategy, particularly in Europe. Some analysts wondered if they'd consider a large-scale acquisition there, given that some European tower companies seem open to selling.
So are they looking to make a big splash across the pond?
Well, they didn't rule it out, but they emphasized their disciplined approach. They're not going to overpay just to gain market share. They're looking for deals that fit their strategic criteria, that create long-term value, and meet their financial hurdles.
Makes sense. Acquisitions can be risky if not done carefully.
Exactly. They highlighted some of their key considerations, including favorable terms and conditions, strong counterparties with a good track record, and a healthy co-location dynamic. They're looking for acquisitions that enhance their existing business model and accelerate their growth.
So they're not just chasing deals for the sake of deals, they're being strategic and patient.
Precisely. And that patience might pay off. They noted that they're seeing more competition on network quality in Europe, which is actually a good thing for American Tower. It means carriers are investing to improve their networks, and that drives demand for new tower builds.
Ah, I see. So instead of just cutting costs, carriers are actually stepping up their game, which benefits infrastructure providers like American Tower.
Exactly. It creates more opportunities for growth. And on top of that, they highlighted the role of government initiatives in Europe, which are pushing for ubiquitous coverage, including in rural areas. This government support is creating a more favorable environment for investment and helping to fuel the growth of their European business.
Okay, so Europe is a bit of a mixed bag. There's competition, but there's also government support and carriers investing in better networks. Overall, it seems like a promising market, but they're not going to rush into anything.
Right. It's about finding the right opportunities at the right price and making sure those acquisitions align with their long-term strategy. Now let's shift gears and talk about their data center business, Corsite. There were some interesting questions about their strategy there, particularly about whether they might consider entering the hyperscale development game.
Because those massive hyperscale data centers have been such a hot trend in the industry, investors are always wondering if American Tower is going to jump on that bandwagon.
And it's a valid question. Those hyperscale facilities generate a lot of buzz and they can be very profitable. The American Tower has been very clear that they're not chasing that trend, at least not in the same way that some other data center providers are. They believe their existing multi-tenant colocation model, with its focus on interconnection, is a better fit for their strategy.
So they're sticking to their knitting, focusing on what they know best.
Exactly. They're comfortable serving a diverse range of customers, not just the hyperscalers. They see more consistent returns in that approach, and it allows them to leverage their expertise in building those robust interconnection ecosystems that we talked about earlier.
Okay, so they're not ruling it out entirely, but it's not their top priority. Now, I remember they mentioned a large land purchase during the call. Did they provide any more details about that?
They did. It was a land purchase in Los Angeles, and it's intended to expand their existing campus there. Essentially, they're securing more space to accommodate future growth and ensure they have enough capacity to meet the increasing demand from their customers.
Makes sense. Planning for the future is crucial in a fast-growing market like data centers.
Right. And they emphasize that they'll continue to invest in land around their existing campuses. So this LA purchase is likely not a one-off. They're being very proactive about securing their growth potential.
So strategic land grabs, essentially. Now, one of the big questions hanging over the data center industry is the future of edge computing. Remember we talked about how Corsite sees this as a potential growth driver, but it's been slower to develop than some had expected. Did they provide any updates on that front?
They did, and it was a little bit of a mixed bag. When it comes to inferencing, which is the process of using trained AI models to make predictions, they're actually more bullish than ever. They're seeing strong demand for inferencing services, and they believe Corsite is ideally positioned to benefit from this trend. Their facilities act as a key distribution channel for those large language models that power AI, so they're right at the heart of this burgeoning ecosystem.
So they're a key player in the AI revolution. But what about edge computing? Is that still on track?
While they acknowledge that edge computing has been slower to materialize than they initially anticipated, they pointed to a couple of factors contributing to this delay. On the wireless side, the transition to 5G standalone infrastructure is taking longer than expected. And on the wireline side, they're seeing a gradual evolution towards more distributed architectures. But it's a process.
So the hype got ahead of the reality, as it often does with new technologies. But they're not giving up on edge computing, are they?
No, they're not. They still believe in the long-term potential of edge computing, and they're actively working with partners on those proof-of-concept projects, testing out different use cases and seeing what works. They're also encouraged by the broader trend towards decentralization in the tech industry, which they see as a tailwind for edge computing.
So it's a long game, but they're staying engaged and keeping their finger on the pulse.
Exactly. Now, one more point about Coresite before we move on. They emphasize that they're not chasing every single opportunity in the data center market. They're being selective, as always, prioritizing projects that fit their strategic criteria and generate strong returns. It's about disciplined growth, not about chasing every shiny object.
Which is consistent with their overall approach.
Yeah.
Now, should we shift gears and talk about their capital allocation strategy and their plans for the future?
Absolutely. That was another key area focused during the call, and there were some really insightful questions from analysts. Let's dive into those next.
Welcome back to TalkTickers. We've been dissecting American Tower's Q3 2024 earnings call, and so far, we've seen a company that's navigating a complex landscape with a mix of confidence and caution.
You've captured it perfectly. They're not shying away from the challenges, but they're also not making impulsive moves. It's a very calculated approach.
And one of the areas where that calculated approach is most evident is in their capital allocation strategy. Investors always want to know how a company plans to use its resources, especially those excess profits.
Right. And American Tower addressed this head-on during the Q&A. Analysts were particularly interested in their dividend policy, given their projected mid-single-digit growth rate. Income-oriented investors, as you know, are always keen on those dividend payouts.
Absolutely. They want to know if those payouts are sustainable and if they can expect those dividends to grow.
And American Tower delivered some reassuring news on that front. They reiterated their commitment to their dividend and even signaled that they plan to resume dividend growth in 2025.
That's music to the ears of many investors who've been holding AMT for those steady payouts.
Indeed. But they didn't just make a vague promise. They provided some context around their thinking, explaining that their long-term view is for dividend growth to roughly mirror their average AFFO per share growth rate.
So essentially tying those dividend increases to their overall earnings growth. That sounds like a prudent and sustainable approach.
Exactly. It ensures that they're not paying out more than they can afford, which is crucial for maintaining a healthy financial foundation. They did emphasize that this is a long-term view, so we shouldn't expect the dividend to move in lockstep with earnings every single quarter or even every year.
Right. There will be some variations depending on market conditions and other factors. But the key takeaway is that they're committed to those dividends and they plan to grow them responsibly.
Absolutely. Now, besides dividends, they also have a significant amount of excess capital to deploy. They estimated that they'll have between $1.5 billion and $2 billion available annually, even after those dividend payouts.
Wow, that's a sizable war chest. What are they planning to do with all that cash?
Well, they have several options on the table. They could invest it in their CapEx programs globally, which would fuel further growth in both their tower and data center businesses. They could buy back shares, which would return value directly to shareholders and potentially boost their stock price. Or they could reduce their debt, which would strengthen their balance sheet and give them even more financial flexibility.
So it's a balancing act, weighing those different options and deciding how to allocate those funds to maximize value for shareholders.
Precisely. And they'll be making those decisions based on market conditions, their strategic priorities, and their overall assessment of where they can generate the best returns. But one thing's for sure, they're not going to let that cash sit idle. They're actively looking for ways to deploy it effectively.
That's what you want to hear as an investor. Now, before we wrap up this deep dive, I want to bring it back to our listeners. What's the key takeaway for someone who's considering investing in American Tower or who already holds AMT in their portfolio?
That's a great question. I think the key takeaway is that American Tower is a company in transition. They're adapting to a rapidly evolving landscape, and they're doing so with a combination of boldness and prudence. They're making big moves, like the India sale, but they're also being very deliberate in their approach to capital allocation and growth investments.
So it's a company that's not afraid to embrace change, but they're doing so in a thoughtful and strategic way.
Exactly. They're not just reacting to industry trends, they're actively shaping their own destiny. They're focused on their core strengths, they're managing their risks carefully, and they're making decisions that prioritize long-term value creation. That's a recipe for success in any industry, and it's what makes American Tower a compelling investment story.
Well said. I think we've covered a lot of ground today, and hopefully our listeners have a much clearer understanding of American Tower's current position, their strategy, and their outlook for the future.
I agree. It was a dense earnings call, but we managed to distill the key takeaways and provide some valuable insights for our listeners.
And that's what TalkTickers is all about. We take these complex earnings calls and break them down into bite-sized pieces that investors can actually understand and use to make informed decisions.
Exactly. We do the heavy lifting so our listeners don't have to.
Couldn't agree more. Thanks for joining us today on TalkTickers.
Until next time.